guys, let's make a bit of headway. Okay. But guys, the reason I went a little bit slowly over there, because it's a very important part. Obviously, options is key. We had to just slow it down just to make sure we got the intro right. We jump straight back in now to another very, very important concept called the principles of forward pricing. And remember, guys, the principles of forward pricing for the same price I could have said the principles of futures pricing. Same thing. We price and we value forward contracts the same. Now, let's go. First of all, before we, unfortunately the notes jump ahead a little bit more than I would have liked, but we're going to have to jump a step back. Now, just before we carry on, and I'm just going to show you this very briefly. It's nice and simple, nothing too crazy, but we do go into much greater detail in its respective place. Okay. The very first thing I want to just talk about when we talk about principles of forward pricing, we don't deal with it much here. We talk about this concept, guys, called FOT. Often people call it FOT. What's FOT? That's the forward price. What does the OT stand for? The 0 is now. The T is the end. You happy with that? That's why we denoted FOT. How would that change if it was a futures contract? How would the notation change? It's a massive change. The big F becomes a little f. Wow. That's all. And still 0T. And some books denote it differently, but it makes no difference. We're looking for the same thing. Now, we don't deal with it now, but I'm just going to show it to you very briefly just to give you a full picture. Remember what we said before? What did we say before? You remember my example with Farmer? And we said that the forward price was equal to $5.80. Do you remember that? How did I get to that, by the way? Remember, when did I set that price up? Up front. Now, remember, to price a forward contract, there's two very, very, very important concepts you've got to get. There's a big difference between pricing and valuation. Pricing is the price, 580. What's the value? We'll talk about the value in 3 different contexts in a second. But let's talk price first. The price of 580 is what, guys? Okay, how did I get to that? Look over here. SO, spot price today. Happy? Open your brackets. 1 plus my risk-free rate, okay, to the power of n. This is the discrete way. There is a continuous way as well, where we use logarithms, exponents. We'll do that. But I'm just showing you the general point. Now, if FOT, the forward price, guys, can be calculated in this manner, what is this? It's a future value, that's all. Nothing fancy. Just a future value. What's interesting, guys, is that now when you see the forward price, and it makes sense, doesn't it? Because we're trying to determine what the price will be in the future. So what's the best way to do it? Future value calc. You happy with that? Nice and simple. Okay, you guys comfortable? Okay. Now, that's price. You happy how to calculate price? Okay, let's move down to value. Okay. What is the now? So how many different prices can I have, guys, in a forward contract? Just the one. When's it set up? Up front. Does it ever change? No. Remember, both forwards and futures fall into what category? The category of forward commitments. You're in, no way out. Okay, good. We then look now, guys, at values. Now, if I had to say to you, give me some values. The value of a forward contract. When could it, give me 3 possible times you could value the contract. Time period 0, good. During, we call that little t, any time in between, and big T at the end. Now, let's go. What's the difference between value and price, guys? Okay. Okay, but what is it? What's the difference? You haven't told me the difference. I'm being a bit anal tonight. I'm sorry. The price at that point in time, I don't love it. It's worth. Oh, okay. Whereas you can, when my throat gets sore, you can come and give the class. Okay. Okay. It's the worth. It's the value. You happy with that? Now, if it's the value, Letty, talk to me. Time period 0. What's the value? I'm pushing everyone tonight. Does any money change hands at time period 0? 0. What's the value? 0. Nothing's happened. So the value at time period 0 is 0. Okay. Let's skip to big T. What's the value at the end? Now, think back, guys. Remember, think back to my my example with Farmer and Jones. What was the value at the end? $1. Remember that. Just $1. How did we work it out? It was the value at the end, the spot price at the end, you happy? S big T less. What? The price, am I right? Of 580. Does that make sense? Happy. That's its value. And the value, remember, I'm going back to my previous example, was $1. That makes sense? Because remember, it's the value at the end. Value, Lwazi says, is worth, is profits almost. How much did you make? It'll depend what side of the transaction you're on, but it's always going to be the difference between the price at that point in time and the forward contract. The forward price, which is FOT. What about little t? That's your difficult one. Again, so you'd go S, spot price, you're happy. When? At that point in time. And then what do you do? I'm not going to do the whole thing with you guys. I'm going to just summarize it for you. Less FOT at time t. And how do you get FOT at time t? Because when is FOT really? It's at the end, isn't it? So how do you get it back to time t? You present value it by a little bit. That's how you get to that number. I'm not showing you detailed calcs. I'm giving you understanding now. The detailed calcs will come. You guys comfortable? So there's 4 things. Price, we know. Price is equal to future value calc FOT. Value, what's it worth? At time period 0, it's worth nothing. At the end, it's worth the difference between what you can sell it for at that point, the spot price at that point in time, and the FOT. And anywhere in between, you look at the price at that point in time plus a present value of FOT to that point in time. Yeah. Correct. Yep. That never changes. It's set up up front, never changes. You happy with that? Okay. Let's go. Back we go. Look over here. What's the payoff on a forward diagram, guys? Oh, wow, you've seen this now. It's ST less FOT. You happy? For the long. For the short, it's the short is the seller, isn't he? Now, does this make sense? If you're the seller, what do you receive? What price do you receive if you're the seller? What price do you receive? You receive FOT, don't you? So for you, your payoff is going to be FOT less whatever price it is at the end. You happy with that? Just looking at from whose point of view. Who pays FOT and who receives FOT. You happy with that? That's all. Okay. And then we've seen this example already, page 11. Guys, I'm not going to spend time on that. Okay. There we go. Okay. I'm not spending too much time on it. Is everybody comfortable, though, more or less? And guys, we're jumping quite headlong into derivatives, but we're just seeing basic intros at this point in time. Okay. 28E, differentiate among the broad categories of traders. Hedgers, what do? They hedge. That's their job. Good. And that's long-term positions that they've got in. They're not there to make profits. They're just there to mitigate risk. So whatever the risk is on the one side, they mitigate that on the other side. Speculators, they're there to make profits. And arbitragers make money off just short kinds of transactions. What's the one that we haven't seen that some of the books like to put in, guys? What do you think? With another bit of a, even worse than a speculator? Gambler. Day traders, yeah. Day traders, well, you can call them gamblers. Same thing. They like to think that they've got skills. Okay. As did I when I day traded. When I left my private equity position, I was bored. So I thought, let me start to day trade. And for 3 months, I was coining it. I couldn't call a single thing wrong. It was just like Midas touch. And the day after the 3 months, I lost everything plus. In one day. And I'll tell you about transaction. It was the 2007 and 9 global financial crisis. Okay. And it was easy. You just went short. Because everything was going down. and I took a massive short position, which you should never do as a day trader. The day trader rules are keep your position small every day that you can afford a little bit of a loss. What you made the previous day, you can. Okay, I bet the house on it. 3 months worth of profits, and I went short Old Mutual. And I was trading with a mate of mine, and I attended a meeting. I went into the meeting about 8:30, smirking like a Cheshire cat, thinking just can't wait for the market to open. The prices are going to drop, and then my phone starts to buzz as I'm in the meeting. I'm thinking, why is he phoning me? Okay, so I quickly click onto just the major indexes. Banks are hugely down. Insurers are hugely down. I'm thinking, we're making tons. We're making fortunes. Why is he phoning me? Left the meeting. Every single banking stock and insurance stock was down on the day, except one that I picked, called flippin' Old Mutual. Okay, and not only was it up, but it was up about 9 or 10% on the day, which is an unheard of move. They'd done a deal to get rid of one of their operations, which was unprofitable, which the market loved. They were waiting for them to get rid of this particular arm, and the market reacted brilliantly towards it. I picked the one stock out of about 35 stocks. It was the wrong way, and it moved horribly against me. I then moved out of day trading, and I got back to proper work again. Okay, so I've learned my lesson. Okay, but guys, just an important thing about that lesson, guys, okay, is when you're day trading, and I was day trading with the use of derivatives, okay, it's highly risky stuff, guys. Remember, because what do derivatives do with everything, guys? They magnify the gains and losses. You happy with that? So remember, whatever you 10%, what would have only cost me 10% on Old Mutual ended up costing me about 100%. Okay, because of the leverage that they use. Okay, gearing's the killer. Now we're going to move to some hedging, guys. We're going to hedge using forwards. We're going to hedge using options. Let's go. Now, and guys, it's so vital that you get this. We really got to put our heads to. I know it's getting late. We're not even at 8 o'clock yet, but we've got to really put our heads together here. Let's go. Okay, a hedging strategy is used by an investor to reduce or eliminate their risk in the underlying asset. We use 2 different ways of doing this, guys. We use forwards and we use options. Okay. Now, remember, guys, always, if you are long something, how do you protect yourself? Go short. If you're short, you go long. Why? It's not rocket science, just you're neutralizing your position, aren't you? Correct. Let's say, for example, I've got a phone, and I've promised somebody else that I'm going to sell him the phone. So I promise I'm going to sell you a phone in a month's time. How do I mitigate my risk completely? I buy a phone, don't I? Because then I've got the phone to deliver. So whatever position you are, take the opposite position in order to hedge your particular risk. Let's go. I'm going to start off using forwards. We're going to move from forwards. We're going to go to the use of options, and you can see the big difference, guys. Let's go. The investor is long. Let's talk about long. Okay. And let's just talk about, let's pick anything that we like, guys. And the investor is long gold. What's his concern, guys? And guys, always look at it. So let's go steps. Underlying position, you're long. You got it at home on your dining room table. Please don't leave it there. You got a bar of gold. What's your risk besides thieves? The price of gold will go down. Simple. The risk that when the investor wants to sell his gold, the price has gone down. Simple. That's a commodity. Okay. How do you mitigate that, guys? Because you worry that in 3 months' time when you want to sell, what will happen? The price will have gone down. So what do? Sell it now. Sell it in 3 months' time, but fix the price now. If the prices go down in 3 months, who cares? Because you have already established. Fact, am I right? You've set the price up now. Nothing will ever change that. You happy with that? So let's go. Underlying position, you long. Your risk that prices go down when you want to sell it. How do you mitigate it? Sell it now. Now remember, guys, if you want to sell it now, how do we do this? A forward contract, you'll never get away with that with me. Give me more. Give me more. No, I'm not accepting these answers yet. What do? I want the exact. Are you long or are you short the forward contract? Short. That's what I wanted. Okay, I know I'm pushing hard, guys, but it's important that we get the fine details of derivatives because they tend to bite you if you don't. You happy? So, and remember, when I'm short a forward, what have I done? I've sold something. I fixed the price now, but I'm selling it in 3 months' time. But the price, the quantity, and all the stuff, it's all set up now. You happy with that? Okay, let's go next one, guys. That's good. The investor is short. Let's say, for example, I've sold a stock short. This is a little bit difficult to see. Okay. And remember what we spoke about selling something short. What do you pray for when you sell something short? You hope that prices go down. What's your risk? That prices go. Remember, on a short transaction, what do you have to always do? You borrow, exactly right. So you borrow the stock, you go short, you sell it, and then what do? In 3 months' time, at the end of the time period, you've got to buy it back, don't you? What are you hoping? That the price has gone down. So when you buy it back, it's much cheaper, isn't it? If prices go up and you are short, we see that whole concept called short squeeze. Am I right? Good. Okay. So what would you want to do? You want to fix the price now. So in other words, you want to fix the price that you're going to buy it now. Again, what's your transaction? You go long. You guys comfortable with that? It's so important that we get the transactions right. Good. Okay. And if I tell you this again, I think someone will throw something at me at the back, but I'm going to say it anyway. Keep in mind that in terms of a forward transaction, okay, there's no upfront payments. When you see that, alarm bells should start to go off in your head, and what should you say? Okay, well, there's no upfront payments. Based on that, the value of a forward or future contract at inception is 0. Good. Okay. But yes, if there's no upfront payments for a forward or future contract, there are upfront payments for a options contract. You happy with that? Based on that, guys, what would you tell me more? An options contract has a value up front, doesn't it? Good. Okay. And however, the parties are obliged to transact at the end of the contract term. There should be nothing there that should upset you too much. You guys comfortable with that? Okay. And we've looked at this many times before. I'm not going to spend too much time. Let's just have a quick read through it, in fact. Mr. Jones enters into a forward contract with Mr. Farmer. In terms of the contract, he agrees to buy wheat at a price of $5.80. At expiry, the spot price is $6.80. Now, let's just do a quick revision over here, guys. Remember, what would you call the $5.80? I want names. FOT. How did I get to FOT of the $5.80? I would have gone spot price at that point in time, 1 plus the risk-free rate to the N. Happy with that? Derivatives, they tend to replace N with a T because they like the maturity being a big T. Makes no difference. What would you call the 680, guys? S what? S what? Okay. We'll keep going till we get it. ST, you guys comfortable? SO is what? The spot price? That would have been that one, wouldn't it? The spot price at the beginning, which is used as a basis for calculating FOT, but that's as much as we use it for. If he wasn't hedged, and Mr. Jones wasn't hedged, what would he have to buy the wheat for? ST, $6.80. You happy? Because he wasn't hedged. Remember, Mr. Jones was hedged. Okay, and based on him being hedged, he gets to buy it at what price? $5.80. You guys comfortable with it? Nice and simple. Okay, now a little bit more tricky, but still okay. Let's use options. How do we use options to hedge? Same story, guys. Okay, let's start. Oops, what have I done there? Okay, let's go. Okay, the investor is long. That's his underlying position. What's the risk if you are long that prices go down? What's the risk mitigation? You want to fix the price. Now you want to sell now. Okay, Shana, you're going to get another chance to redeem yourself. Not that you need redemption. Okay. Forget about Mr. Jones. Just think about this. Guys, you can all jump in and help as well. You are long an asset. What's your worry? That prices will go down. So what do you want to do? If you're doing a futures contract or forward contract, you would enter into you would want to fix the price to sell now, wouldn't you? You would go shorter forward contract. I'm using options now. You've done options. How do I protect against prices falling with an option? Put option, I like it, give me more. Fantastic. Okay, you both get a half, but remember, you can't write the exam together. Okay, so two good brains, but they don't combine in an exam. Okay, it's a long put. Remember, anything now where you want the option and you looking to hedge, what better you be doing? You better be going long. Am I right? So both of these, whether you long or you short, whatever you are, what do you see for options, guys? It's a buy and a buy. A long and a long. I'm not talking about shorts over here. Why? Because a short, I don't have any rights anymore, do I? The difference is if I'm worried, if I'm long an asset and I'm worried that the price is going to go down, how do I protect down movements? I buy a put option. You happy with that? Okay. So if the price does go down, I benefit on the put option. The investor is short the asset. What do I do? And if you short an asset, what are you worried about? That prices will go up. How do you take advantage of that? You buy a call option. Okay, you can fix the price with a call option, can't you? Fix the price today. Let's have a quick look. Wow. Okay. Let's look at the example. If an investor purchased a stock for $100, let's have a quick peek. It's now worth $200, not yet sold. Remember the third animal on the stock market? The pig, the bulls, the bears, and now you've got the pig. He bought it for 100. There's a nice thing, guys. A hedge fund manager, I can't think of the name, made $1.5 billion on Tesla stock in 2 months as the price moved up. $1.5 billion. So when I say don't be a pig, maybe be a little pig, okay, you stand to make some good profits as well. 1.5 billion. I'll send you that. If I can find it, I'll find it for you. It's a hedge fund manager that's just done exceptionally well on one stock. Okay, so look over here, guys. It was $100. It's now worth $200. Okay, you've got what we would call an unrealized gain of 100. Okay, Desiree, I'm picking on you right there. Just because you moved to the back doesn't mean I can't pick on you. Okay, what's your worry now? What's your concern? It's gone from 100 to 200. You made $100, but you haven't sold it yet. What's your worry? That it starts to drop now, right? Because you're in a bit of a pickle now. Because you think to yourself, well, if I sell it, will I bank $100 profit, but it might go up some more, won't it? If I don't sell it, it might go from the 200 back down to the 100. I lose everything. Okay, so what do? Okay. You enter into what's called a, okay, who wants to help me here? What's my transaction? So remember, straight away, you long. Whatever you do over here, you're going to go long because you want the rights, don't you? Longer what now? Mopa says longer put. Joy, what do you say? You with Mopa? Okay. Letty's in. All the ladies. What do the guys say? Mo, you up front here? There's no... Giving others a chance. Yeah. Can I give you a bit of a... next time when I send out my adverts, I want to advertise. There is no, by the way, in my classes, there's no fence to sit on. You got it. There's a... Okay, you got to have a view. Javesh, what do you say? Longer put. And why does longer put help you? Because what happens? Remember now, I've got two things. I'm long. Now, the minute you see the word long, what do you say? Oh, brilliant, I've got rights. Put means I'm protected against prices going down. So now let's go. What happens if the price of the stock moves to $300? By the way, sorry. Remember, let's go. I started off at $100. You happy? The price moved up to $200. Happy? That's where I stand now. Tell me something. If you wish to protect yourself, what would you set the exercise price at? Because remember, you are going long a put. You're buying a put. Tell me the X. Give me X. Mopa says 200. So 100 or 200? 100, so I don't want to put words in your mouth. You should have gone with the 200.
I think, yeah, exactly.
So Vest goes for the 200. You want to protect your 100 gain that you've made. Do you see what I mean? Not just your 100. You could maybe, but I want to protect the gain, don't I? You happy with that? So I set my X at 2. Now, when I set the X at 200, what am I doing? As soon as the price goes below 200, I lose money on the stock, don't I? But I make it back on the long put. You happy with that? Okay. Assume the price of the stock, number one, moves to $300. Then what happens, guys? Well, remember, I still own the stock. Shout, Courtney. I don't exercise. I walk away. Fantastic. When will I exercise? I only exercise if it's 200 or below. 300, I'm not exercising. I walk away. What do I lose? The premium. Fantastic. Fantastic. Okay, so I lose the premium. What was that? $5, $10, whatever. But I don't exercise, and I pocket another $100 from 200 to $300 because I still own the stock, don't I? I'm smiling. What if the price of the stock falls to 50? Talk to me about 50. Let's go. And remember, guys, when you're hedging, when you've got an underlying position, plus a hedge, plus a derivative, there's two transactions, aren't there? That's the hedge. You've got an underlying position, but then you use the derivative to protect it. Let's go. So let's talk about my stock. And let's talk about, remember, I am long a put. Talk to me about number two. The price of the stock falls to $50. What happens? So the stock price goes from what? $200 all the way down to 50. So I'll put it in red. A loss of 150. You're comfortable on the stock. On the puts, my X is equal to 200. So I've got the option to sell it to you at what price? 200. But what's it trading on the market? What can I buy it for? 50. So I buy it for 50 and I sell it to you at what price? A long put at 150. Sorry, 200, and I make a gain of 150 less the premium. Mope away, let my premium go. And that, by the way, that's where you're going to make the real money. You've got to focus on the premium because that's also something, isn't it? Tell me something more. Now you've got me started on premium. You shouldn't have started there. What do you think the premium would be? So we've set our X. I can't help me here. You set your X at 200. You happy? Okay. Because you wanted to protect the downside completely. What do we say about that? Your option premium is going to be cheap or expensive? It's expensive because you're protecting. You're ready. If the SO at that point in time, guys, is 200, and you set your X at 200, what would we call that? That's already at the money, isn't it? You're already at the money. Those are expensive. What would you do if you wanted to make it a bit cheaper for yourself? In terms of option premiums, make your X a bit lower. So you're prepared to take. You say to yourself, well, listen, I've already made $100 from 100 to 200. You happy? If I don't make that much money, it's okay. So let me set my X at maybe 170. So the first 30 is on the house. I got to bear that. But your option premium will be much lower then. You happy with that? Okay. Good. Okay. Now, we do the last little bit over here. Let's do some speculations, guys. Okay. And guys, you're going to see the power now of leverage. Let's have a quick look. Okay. So is everybody happy that at this point in time I've hedged, shown you how to hedge with futures and showed you how to hedge with options? We showed you what your underlying position is, then we showed you what your risk is, then we showed you how to hedge. Let's do the same thing now with futures and options, but now let's speculate. It's much more fun speculating. Okay, let's go. An investor's got $1 million to invest. He would like to invest his money in Apple Incorporated for a period of 6 months. Current spot price is $200. Guys, you can see how old these notes are. They're not so old. They're only a year old. But Apple's already at well over 300 now, isn't it? A massive gain. They've dropped back a little bit because, I don't know if you guys caught yesterday, there was an announcement coming out from Apple that their sales won't be as good because of the coronavirus. Demand is slightly depressed. So they did take a bit of a dip. But if you have a quick look, if I can find it for you, I will quickly. If not, we're not going to worry. But Apple Corporation here was $200, it's $318. So it's and remember, guys, if I take you back just a few years ago, what did Apple Corporation do? They were sitting at $700, and they had a 7-for-1 split. So they split the stock to make it more tradable from $700 to $100. It's really gone from 100 up to about 318 again. 3 times money. Okay, seems like a good stock to be. 1.4 billion market cap. Okay, so I've got $1 million to invest. Current price $200. Now, I'm going to look at it from 2 points of view. Let's look at it from the spot transaction and then the futures transaction. The spot transaction, what would you do? Well, I've got $1 million. You happy? $200 a share. Everyone comfortable? I can buy 5,000 shares. Okay, you happy with that? Okay, good. Okay, let's go. Okay, now let's go at the end, guys. At expiry, we look at 2 possible prices, guys. Okay, we look at the price might have gone down to 190. You happy? Or it might have gone up to 230. Let's look at the differences. If it goes down to 190, what do I lose? $10 a share. You happy? From the $200 to the 190, I've owned 5,000 shares. I lose $50,000. If it goes from 200 to 230, I make $30 a share, times 5,000, I make 150. Everyone comfortable with that? Those are easy calcs. On a futures transaction, what does it tell me? Okay, the futures price for 6 months is 220. First of all, what would you call the 220? Give me its fancy name. Call it FOT. You happy with that? How did I calculate? Just a futures value calc. Initial margin, $20 per share. You happy with that? So if I put down $20 a share, I've got the right to buy a contract, don't I? So let's go. At inception, you happy my $1 million, and $20 I need to put down per share. Now I can be transacting in 50,000 shares or contracts. Am I right? Look at that, 50,000 versus 5,000, 10 times leverage. Wow. Okay. Now let's go. The price at the end of 6 months was 190, just like it was on the spot. What happens there? What have I done? I've agreed to. Okay. I've agreed to what? I entered into a futures contract to buy at what price? 220. It's currently sitting at what? 190. Why did I just walk away, guys? Because it's not an option. Literally, it's not an option. It's a futures transaction. It's a forward commitment. So I lose $30 a share. You happy? Times 50,000, I lose 1.5 million. The same price, guys. Okay. On the spot, I lose 50 and I lose 1.5 million on a futures transaction. What's that called? It's just one fancy word. Gambling. That it is too, but what's the real word I'm looking for? It's the L word. Leverage. Okay, good. What if the price goes to 230? Well, I buy at 220. You happy? I sell at 230 times 50,000, and I make $500,000. The only thing that you see from this whole nice example is that what? Okay. Derivatives. One of the key parts of derivatives is leverage, and that leverage can really hurt you if you're not careful. Correct. So correct. It's risk and return, isn't it? Just how risky you feel. Okay. Okay. Let's look at options now. Same story, guys. Nothing's changed. The only thing I've got over here, the options price is 210. That's my X. Am I right? So X. Oops. Mess. There we go. X is 210, and the cost of the option is equal to $10. You happy? Let's go. Same story as before. But look now what happens. So nothing's different on the spot transaction. You comfortable? Nothing's changed. Let's look at the futures sorry guys, and again, please just excuse me over here. I see this now. That shouldn't say futures, it should say, of course, options. You guys comfortable with that? Okay. Okay. How many contracts can I get now? Remember, how do I enter into a contract? I've got to pay my option premium, which we said was how much? $10. So now I can get 100,000 contracts, can't I? Happy with that? Let's go. And what was my X? My X was 210. You happy? Now, what happens if the price is at 190? Let's go. So the first time the price is 190. So what I lose $20 a share. Am I right? Well, it's the difference between 190 and 210. Am I right? You all comfortable? Are you all comfortable except Shayna? I lose $20 as an option. Am I right? Yes? No? Why not? Okay, you guys comfortable? Okay, you lose nothing here other than your option. Why? Because remember, yes, it's gone down to 190. Am I right? But at 190, what do we say? You say you've bought you long a call. So you say to yourself, well, I'm long a call, which means I've got the right to buy at 210. If ST is currently sitting at 190, I'd have to be out of my mind to buy at 210 if the actual spot price is at 190. Am I right? So what do I do? I walk away and I lose my option premium. What's my loss in this particular example? 100,000 options times the 10 that I paid, I lose $1 million. You happy with that? Like that. Okay, you happy with that? Okay. I'm sure you're not happy with that, but that's the calculation. But you remember, guys, that is your max loss, isn't it? Lawazi was also alluding to that. That's your max loss, what you put in, am I right? Okay, so you can always be a little bit comfortable on an options contract that, let's say, for example, you got $1 million, you can buy 100,000 contracts, and that's your max loss. You can't lose more than that. Does that make sense, guys? Okay, now, what about if the price goes to 230? Okay, now I just want to show you a quick calc. You've done it already, but I just want to bring back some, hopefully, good memories. Okay, let's go. Who wants to help me with the calc? Let's do payoff first. Payoff for a long call is equal to, remember, guys, it's a max of 0 or ST less. We don't talk about FOT in future, in options we talk about it, but it's this X is, I don't know what you're talking about. Let's clean it up a bit, guys. Let's put some numbers to that, and what would you tell me? Let's go. So 0 or ST is what? What's the final price? 230. My X is 210. Remember, X was 210. So which one would you rather have, 0, guys, or 20? Thank you. I'll take the 20. And in memory of Mopo, don't forget to take off your premium of 10. So what's your payoff is 20. Your profit is 10. And don't forget to times by the 100,000. And my profit is $1 million. You guys comfortable with that? And just remember, guys, start to get the terminology right. There's a difference in payoff and profit. Two different calcs. Okay. And if you're not sure what to do, guys, I just want to change this around just a little bit. Look over here, guys. Let's just clean there and let's clean here. Let's go back to my 190. What was my 190 case? So the ST was 190, am I right? When ST says 190 less 210, you happy with that? Which is minus 20. You happy? Which one would you pick? 0 or minus 20? You pick 0. In other words, you walk away. You guys comfortable with that? Always a nice way to go back to your payoff equation and just to see what you're going to do. Why don't we do payoff calcs for the short call or the short put? He's got no option. There's no max calc for him. He can't walk away. He's got no 0 calc. He can't walk away. These calcs, the max calc is only for the long call or the long put. The long person. You happy with that? Okay. Good. A little bit of arbitrage over there, guys. Generally speaking, the way that we price, what is arbitrage? Arbitrage is risk-free profits, am I right? Okay, risk-free profits. Okay, what do you do for a risk-free profit? You go to the Pick and Pay and you buy this. I was there today with my Lati. I was buying mineral waters, he wanted chocolate. Okay, so I got the mineral water, he got the chocolate, and I just had a little bit of time, not a lot of time on my hands, but I was just looking around at prices and just trying to take in the whole experience, which I don't normally shop, so it was something new for me. And it was $4.95 for this. Okay, that was at $4.95. Now, and the reason it just struck me a little bit is because I was running late on Monday, so I had to buy my water from the coffee shop downstairs, and that was 18 Rand. Okay, so forget about prices, and the idiot me should buy them more. There's a Checkers here. If I had time, I'd walk to the Checkers. How do you profit from that? So you go to the Pick and Pay. Remember, and this is the rule behind arbitrage, guys. You buy the cheaper one, you sell the more expensive. You go to Pick and Pay and you buy 10 mineral waters. Okay? And what do? You hide behind that little plant at the coffee shop, make sure they don't see you. All right? Because they'll throw you out. And anyone that comes past and say, listen, come buy the water from me. Okay, so you buy it cheap and you sell it more expensive. And what's going to happen in a real market situation like that? You buy cheap, you sell more expensive. So what happens? So you buy, am I right? And what happens if the price goes up and up and up and up due to the demand? And you sell expensive, and it goes down, and it meets somewhere in the between. But very important, guys, the law of one price says that a mineral water is a mineral water is a mineral water. It should cost the same wherever you are. Given, of course, we know market forces, but hey, given all of that, taking that into account. Correct. Which is what we assume for derivative pricing. For derivative pricing, we assume that you can't, there's no arbitrage, there's the law of one price, no gains. And that's why, by the way, guys, when we price derivatives, what I use as my rate always? The risk-free rate. You happy with that? So remember, guys, you never have to guess what rate to use for derivatives because it's the risk-free rate. Why is it the risk-free rate? Because I'm working with, there is no arbitrage. We work with the law of one price. Okay. And we just look at some risks of derivatives. Okay. We know we've seen risks up until now. The position may not go your way. Now, I know we're late for time, but I don't mind at all. Okay, I want to just get us as ready. Is everybody happy that we've seen derivatives? Now let me show you how they asked it. You see, we've seen all the different parts. Let's see how they ask it. Let's have a look. Because remember, the most difficult one, if I take you right back to the beginning, a derivative can be based on what? A commodity, an equity, a bond. And if they really want to get nasty, what do they base it on? Foreign exchange. Am I right? If they really want to get nasty, based on foreign exchange, because that's always hard to work out which way the race goes. You're never sure which way to go. Is it a gain? Is it a loss? So be warned, your question is a foreign exchange question. Is what it is. Yeah. Let's go. Let's have a quick look. A French bank enters into a 6-month forward contract. So let's and now you just stop straight away and you say, okay, T is equal to 6. I'm in a forward contract, and just to make it more as possible crazy as they can, they enter you into foreign exchange, and of course they're going to go you on the sell side, not the buy side. Am I right? Because that just makes it just a little bit more, more funky. Okay, and what's your job? Okay, the French bank is going to sell. So they are short how much? GBP 40 million. Happy. What rate? Euro 121 to 1 GBP. If I had to ask you now, guys, we're pushing hard now. Which is the stronger currency? GBP. GBP is stronger, isn't it? The pound is stronger because this 1 pound buys you 121 euros. Okay, and from the dollar point of view, you can see it quite clearly as well. If you battle with foreign exchange, just try to always go back to dollars and rands. $1 buys you some 20. Okay, I'll tell you a funny story. I'll show you how old I am. You can work it out yourselves. Okay, I was very fortunate. My dad, I was 9, and my dad was working for a multinational who took him overseas, and he took the family with at that point, and we went to Disneyland. Not that I remember much when I was a 9-year-old, but one thing I do remember after that, I was always interested in the markets and that. And my dad told me when I was 9, the rand was stronger than the dollar. It was 80 cents, 80 cents to the 80 South African cents to a dollar. It was stronger. What's that? Correct. Yeah, there was all reasons for it, of course, but it's just amazing when if you think back many years. Yeah, it was. Okay, let's go. Is everybody comfortable thus far where we are? And guys, in a question like this, don't get bogged down. Don't read it all and say, whoa. Slow down. Slow down. Okay. Take all the pieces out. Let's go. In 6 months' time, the exchange rate is euro 116 per GBP. Now, think. I want you to really put your... So, let's go. And let's just put our numbers together. Let's go. So, I've got... Everyone happy? I've got FOT. FOT is equal to 121. You happy? ST, the price at the end is what? 116. Now, let's go straight away, guys. Straight away. And I want thought. Don't give me answers yet. Tell me something on that. First of all, has the GBP gotten stronger or weaker? Weaker. You happy with that? Because remember, it's gone from 121 to 116. If it had to go down to lower low, it'll go to 1 to 1. Then it's already even, not strong. You happy with that? So straight away, when you see this question, straight away, number 1, GBP has weakened. You happy with that? Anybody not see that? Okay. Good. Now, let's have a look. The question is, what's the payoff for the bank? What does the bank have to do? The bank has to give you the 40 million pounds at what price? 121. Okay. And what's happened? It's got the GBP has gotten weaker. Good. So straight away, guys, what could you tell me? Nice and simple. Before we work out gains and losses, we can work out the amount. Is everyone comfortable that the price differential is 5 cents? Am I right? Times that by 40 million. You happy with that? And it's 2 million. Happy with that? Nice and simple. Okay. And guys, obviously, I want you to go back and do this question again at home. Fresh. Cover the answer. Make sure you've understood everything. This is the standard, guys. Okay. Everyone happy with the 2 million? And straight away, what do you see? You look at your answers, and you're so excited you see 2 million, but then you go a bit cold because it's minus and plus. Now you think, oh my word, bless you. Okay. Which way is it going to be? Okay. And gain or loss, guys? From the bank. Bank gained, import a lot. I'm looking at it's very clear. The question says, what is the payoff for the bank? I'm not looking at the importer. Why is it a gain for the bank? Okay. You're happy? And look at, and remember what I warned you guys. I warned you. What is the bank's transaction? The bank entered into a 6-month forward to what? Here's only one word you needed here. To sell. They were going to sell at what price? They're smiling. They're getting 121, aren't they? Then what happened? Well, the pound weakened. So they don't care if the pound weakened because they're still going to get 121, aren't they? So they're smiling all the way. They don't care what happens. But as that rate goes down and down and down, they're still getting 121, okay, on the sale. And what do they have to do? They've got to deliver it, don't they? At what price? 116, whatever it happens to be, and they make the 5 cents. You guys come to it. The key over here was one word, was the sell. And guys, I just want to take another 2 minutes before we close off this particular topic. Can you see how difficult your questions are? I'm hoping to scare you a little bit. Okay, just enough to motivate you. So when you're sitting at home tomorrow night and you think, should I work or shouldn't I work? And guys, I'm begging 2 things. Number 1 is go over this question again. In fact, 3 things. Number 2, okay, appreciate the difficulty. And I can tell you, as I told you before, I'm always honest with you guys. That's why no one's sitting under the aircon. Okay, I'm always honest with you guys. At Edge, my highest pass rate, if I look at my CFA, I look at all my results last year, we had 100% pass last semester, 100% pass rate for FRM Part 2. Not so for Part 1. Okay, I'm not blaming anybody. I'm here to motivate and to try and help. The general thing we find CFA, same story. My highest pass rate, CFA level 3. The international pass rate for CFA level 3 is about 54, 55. We're way above 70 here at Edge for level 3. Level 2, I'm also above the international pass rate. Level 1, we're just about there. Guys, sometimes they write the exam, the level 1 guys need to write the exam first and just say, whoa, whew, really? Okay, I don't want you to have that experience. I want you to have it here and say, wow, this is where we got to get to. Because remember, guys, what have I just done with you guys? We've just done the whole reading, whole topic, haven't we? You never saw a question like this. What do? They take the information and they put it on steroids. And they ask you a tough question. They're not all this tough, but I want you to start to see where we've got to be, guys. Okay, don't let the exam be your lesson. Please. Yeah, no, it's tough. I'd rather be tough on you now than... I don't want to see you back. I do, but I want to see you in Part 2. I need a Part 2 class, guys. Okay. Become my Part 2 class. Don't... Okay. You would have divided, not times. See, I took 40 million times that. If you divided, you would have come to something different on your two different numbers. Okay. Now, the other thing I want to beg, guys, I know some guys have already, and I was just chatting to Mo as well. Mo is a genius extraordinaire. You're going to get him for book 4. Am I right? Those who've had him will know the man is not from our world. Okay. But we're very blessed to have him on board. I think actually just bored him, so he didn't bother to finish it. He's a CFA, he's an FRM, he just got his masters from INSEAD. No, he's just, like when I battle to get the numbers, he derives the models for you from Okay. And I was just chatting with Mo as well, and we agreed that one of the key parts of your success, guys, is please form study groups among yourselves. Husband and wife, you've already got your partner there. I don't know if you work well together. I'm not getting involved. Okay. But if not, somebody else, guys, it's so powerful because on a Saturday morning when you're lying in bed and that phone goes and you think, there's no way. The alarm goes, I'm not getting out of bed. If the phone goes and it's your mate and you're supposed to meet him here at Edge at 9 o'clock, you'll get out of bed because you're meeting with someone. Even if you just sit and work together and after like 2 hours of working together, you say, let's do some questions together like this. Let's go over and let's brainstorm. It is so powerful, guys. There are, of course, people that work better on their own. After all this preaching, I'm one of them. Okay, I'm alone. I prefer to work on my own. But I'm saying it is so powerful, guys. If you can form groups, it's motivational, helps you. Okay. So if anyone wants me to make partners, people are shy to form groups. I don't think there's that much of this group. You all seem quite confident. I'm happy about that. But guys, approach someone and say, would you like to study with me? Okay. Not in a creepy kind of a way. In a wholesome kind of a way, but guys, I'm telling you something, it's what's it? Could be, but it's a powerful thing to work together. Even two, to get together, 2 or 3 makes no difference, guys. It just keeps you where you need to be, if that works for you. Guys, this brings us to about 20 to 9. What I want to do now is I'm going to save this for the guys that are not here. So guys, it'll take me about 3-4 minutes. If you do need a toilet break, and I can take it now, but don't go too far. I do want to start again. Do one more topic at least tonight before we close.